Good afternoon, everyone, and welcome to the day 3 of our revision session. If you are able to hear me and if you are able to see the screen, please just give a thumbs up so that I know that you are actually able to hear me, and then we'll start. Students, if you are able to hear me, please just give a thumbs up so that I know that yes, you are able to hear me and you're able to see the screen. Yeah, okay. So thanks for the confirmation. Now we're good to start. There's some initial setup pickup. Okay, so in the previous two sessions, we understood about two important chapters. That is, one is final accounts, and the second one was what we understood was about non-profit organization. Now, today we will be taking up the next very important topic from your examination point of view, which is partnership accounts. Right. Now, when we talk about partnership accounts, there are multiple types of questions that are tested, but most likely, and the more important area that we need to focus on, and that is what we will be discussing in our revision session, is the aspects related to revaluation. By far, in almost every examination, you have got a question which will be dependent on revaluation, and revaluation comes into picture when we have admission, when we have retirement, and when we have death. Okay, so whenever the composition of firm changes, whether there is a new partner that has come into the business or whether there is an existing partner which has gone out, in all of these cases what we need is the revaluation account that needs to be prepared, right? So the concepts remains the same. If you understand what revaluation account does, then you will be absolutely clear, and again a highly scoring ledger in the examination, right? Then along with revaluation, you will be required to do some kind of goodwill related treatment. What happens when a new partner comes in, what happens when an existing partner goes out, how to handle goodwill. This is second thing which you must be careful, must be aware of. Then you are required to prepare the partner's capital, and then you are required to prepare the balance sheet. Okay, so these are the four main areas which you need to focus on, and if you are through with this, 10 to 15 marks would be easily in your pocket in the examination. So these four aspects are what we will be focusing on as far as the partnership accounting is concerned. Yes, there are aspects related to joint life policy and all of that that will be coming up subsequently. Okay, now whenever there is admission, retirement or death, we say there is a reconstitution of the firm, means something is changing in the firm, and when something is changing in the firm, we will have to bring the assets and liabilities to their current valuation. That is why we prepare the revaluation account. Then because the firm will have some goodwill, the existing partner who is retiring must get a share of goodwill, or the new partner that is coming up, he must pay towards goodwill. That is why we need the goodwill treatment. Now related to the goodwill treatment, we have something called as the sacrifice ratio or the gain ratio. A lot of students get confused as to how to handle this sacrifice ratio and gain ratio. I will tell you two ways in which you can handle the goodwill treatment. Both ways are perfectly fine and you will be able to obtain the marks. Okay. Now coming to partners, we will take admission. Same concept can be applied for retirement as well. Okay, so let us say we have two partners, A and B. They are sharing profit and losses in the ratio of 2:1. Now they have admitted new partner called C. So let us say after admission the ratio becomes 2:1:1. Now when I say 2:1, it is 2 divided by 2 plus 1, 3, and 1 divided by 3. Here it is 2 divided by 2 plus 1 plus 1, 2 divided by 4, 1 divided by 4, 1 divided by 4. Now if you carefully observe, From 2 by 3, the ratio has gone down. It has become lesser. 2 by 3 is 66.6%. 2 by 4 is only 50%. So A is, we say, sacrificing. A is sacrificing his share of profit. Similarly, B 1 by 3 has become 1 by 4. B is also sacrificing his share of profit. And who is gaining? C is gaining. So whenever you have to calculate sacrifice ratio or gain ratio, okay, is equal to the new profit sharing ratio minus old profit sharing ratio. If new profit minus old profit sharing ratio is negative, then we say it is sacrifice. If it is positive, we say there is gain. Now, if I do for A, new profit sharing ratio is 2 by 4, or you can say 1 by 2 minus 2 by 3. Now, some of you find difficulties in doing this LCM thing and all of that. What you can do is directly you can multiply these two. So this can be written as 3 into 2, 6. 3 into 2, 6, right? Because you have 3 and 2, you bring it to a common factor, which is 6. 3 multiplied by 1, 3. 2 multiplied by 2, 4. So basically you are multiplying this and you are multiplying this. So this is minus 1 by 6. So this is a negative number, means A has sacrificed. A has sacrificed. Similarly, for B it was 1 by 3, now it is minus 1 by 4. So 4 ones are 4, 3 ones are 3. 4 minus 3 by 12, 1 by 12. Now, C, if you see, has got 1/6 from A, 1/12 from B. So 1 by 6 plus 1 by 12, which is, if you can do the calculation, 6 you can convert to 12. So 2 by 12 plus 1 by 12, which is 3 by 12, which is 1 by 4. So that is what is the share. Now this is the ratio. Now the reason for calculating this ratio is something related to goodwill. Goodwill is the good name of the firm. Nobody will allow anybody else to participate in the brand name without paying anything. Now what do I mean by that? Let us say there is an established business. If there is an established business and that business wants to admit a new partner, they will say bring something towards capital, and because we have brand value, pay something towards goodwill. So for example, goodwill of the firm, the partners have valued it at, let us say, this was which ratio? I did 2:1. So to make calculation easy, let us take it as 1,20,000. 1,20,000. This is the goodwill of the firm, right? This is what is valued. Please remember, goodwill will never be shown in the books of accounts. Goodwill will never be shown in the books of accounts, means you will not have an item called goodwill in the balance sheet unless the firm has paid to purchase the goodwill. If the firm has not paid to purchase the goodwill, you will not show goodwill in the balance sheet. So then what do we do? See, this goodwill is calculated. This is the something like a brand name or brand value for the firm. Now what you should do is, step 1, you distribute this goodwill to existing partners in old profit sharing ratio. So you have A, you have B, 1,20,000 in old profit sharing ratio. Old profit sharing ratio is how much? We have calculated 2 by 3 and 1 by 3. So 2 by 3 to A, 1 by 3 to B, which is 2 by 3 of 1,23,000 into 40 into 2. 80,000 for A, 40,000 for B. Then, because we cannot show goodwill, you will write off goodwill in new profit sharing ratio. Any type of problem, if you follow these two steps, you will be able to handle goodwill related adjustment. New profit sharing ratio means A 1 by 2, B 1 by 4, C 1 by 4. So 1,20,000 by 2 is 60,000. By 4 is 30,000. By 4 is 30,000. Now, you have given benefit of 80 and 40 to A and B. You have written off in 60, 30 and 30 proportion. So, 80 minus 60, A should get a net benefit of 20,000, B should get a net benefit of 10,000, and C should contribute 30,000. See, this is an entry amongst the partner. Cash movement entry will not be passed. So what you will do is you will say debit C 30,000 to A 20,000 to B 10,000. You don't need to worry about sacrifice ratio and all of that. You can just prepare this table. Credit goodwill in old profit sharing ratio, write off in new profit sharing ratio. If you prepare this table, you will be able to handle goodwill related adjustment. Any doubt on that, please ask in the chat box. Any doubt on that? Okay, so there is one doubt on hidden goodwill. I'll take that question. Okay, so hidden goodwill. Sometimes what happens is, see, goodwill can be calculated using many different methods. Can you please comment what are the methods which can be used to value goodwill? What are the methods to value goodwill? So you have various methods like super profits, capitalized profits, yield method and all of that, right? And one way in which the question can come in the examination is what someone had asked me, hidden goodwill. Sir, what is this hidden goodwill? Hidden goodwill means the question will not tell us what is the goodwill amount. The question will not tell us what is the goodwill amount. The question will give us some other information from which we have to calculate goodwill. So sometimes what happens is, let us say there are partners A and B. Okay, as per the their capitals, A is having capital of 1 lakh, for example. B is having a capital of 50,000. A is having capital of 1 lakh, B is having capital of 50,000, right? C was admitted for 1/4 share. C was admitted for 1/4 share, and for this 1/4 share we asked him to get 60,000. We asked him to get 60,000, right? Now for 1/4 share, if he gets 60,000, what we need to check is how much will be the full value of the firm. So if 1/4 is 60,000, if 1/4 is 60,000, 1 will be 4 into 60,000, 2 lakhs 40,000. Okay, so based on the contribution of C, we have determined that the full value of the firm should be 2,40,000. But this is the capitalized value. How much is the individual value or total of capital? Total capital is 1 lakh plus 50,000 plus 60,000, which is 2 lakhs 10,000. So actually, if you see, the total capital of the firm works out to 2,10,000, whereas what he has got is 2,40,000. This difference of 30,000 represents goodwill. This represents goodwill. This is called hidden goodwill. Are we clear? Okay, so that is with respect to goodwill. Now, carefully in the partners account, please remember, let us say we have A, B and C, and this side also we have A, B and C. You will not say by goodwill, you will say by A, not by, sorry, this side will be to A and B, 30,000 as per our earlier example, okay, not this example, as per our earlier example, 30,000, and in B and C column, you will say, sorry, by C, 20,000, and under B's column, you will have 10,000. This is a goodwill related adjustment. Easily, this can get you, 3 to 4 marks. Means these two entries will give you 1 mark. Calculation and allocation of goodwill will give you 2 marks. So 3 marks can be easily, pocketed by this adjustment. Right now, this was with respect to goodwill. Now, in partnership accounting, whenever there is an admission, retirement or death, the most important account is revaluation account. This revaluation account, think of it as a P&L account. It is not a P&L account. Think of it as if you are preparing a P&L account. Now, tell me, on which side will the gains appear in the revaluation account? Which side will the gains appear in the revaluation account? Okay, Vamsi, I've already solved tougher questions from previous papers. I will take one more from the current RTP and we will solve. Okay. Now, all the gains will come on the credit side. All the losses will come on the debit side. Okay. So, loss means what? For example, value of asset goes down, it will come on the debit side. Value of asset goes up, it will come on the credit side. Liability goes up, debit side, comes down, credit side. So like this, for all the adjustment, what you will do is you will prepare a revaluation account capturing all the gains and losses. Now, these gains and losses, finally, there can be gain or loss. The gain or loss on revaluation will be distributed to partners in old profit sharing ratio. Please remember, new partner will not get anything out of this. It will be distributed to old partners in old profit sharing ratio. Now, sometimes what the partners agree is we will not change value of assets and liabilities. So here we are decreasing the value of asset. Here we are increasing the value of asset. Partner says we will not change all of this. Now in that case, what should we do? In that case, what you should do is you should take all of these items this side all of these items on the other side. So for memorandum revaluation account, what you need to do is, first you will capture losses and gains. Then you will close this by distributing in old profit sharing ratio. Then all these losses you will bring this side, all these gains you will bring this side. Then the net impact will be allocated in new profit sharing ratio. Balances in the asset account and the liabilities account will not change. Okay, so this can be one case where the question can ask that the partners have agreed not to change the values of assets and liabilities. If that is given, you will prepare memorandum revaluation account. Okay, then any reserves will be distributed to the partners in old profit sharing ratio. Any P&L balance to old partners in old profit sharing ratio. Okay, so these are the basic concepts in partnership accounting when there is admission or when there is retirement. Then someone had asked about joint life policy. Now, what is a joint life policy? Joint life policy is policy taken on the partners. Let us say we have A and B. They take a joint life policy such that if, let us say, A dies, so you have something called as sum assured. Let us say 1 lakh. If A dies, the firm will get 1 lakh. If A dies, the firm will get 1 lakh. But let us say now we are admitting C into the partnership. A and B is there. Now we are admitting C into the partnership. The constitution has changed. So this life policy which has taken will no longer be valid. So what we do is we surrender the policy. So whenever we take a policy, every year we pay premium. Every year we pay premium. Sir, what is this premium? Whenever you take a policy, health insurance, life insurance, you have to pay premium. So let us say every year we are paying 10,000 as premium. So the premium entry will be joint life policy, premium account, debit 10,000 to bank 10,000. Okay. Now there are two treatment possible. This premium is treated as an expense. If it is treated as an expense, take it to P&L. But the premium may be treated as an asset. In that case, what you have to do is, if it is treated as an asset, you have to find out what is the surrender value of policy. Surrender value of policy means if we surrender the policy today, what is the amount we will get? Let us say year 1 we paid premium of 10,000. Surrender value of the policy is 4,000. Means if you give back the policy, you will get only 4,000. In that case, what you will do is you will create joint life policy asset 4,000, P&L 6,000 because we paid 10,000 to JLP premium 10,000. Okay, so from JLP premium you will transfer 4,000 to asset and 6,000 to P&L. Sir, we don't want to consider it as an asset. No problem. If you don't want to consider it as an asset, you can charge off entire amount of 10,000 to P&L. So if asset is there, you will have JLP asset 4,000. If no asset, then here you will have JLP asset 0. Now this is a regular transaction. The problem happens or the challenge happens when one partner retires or one partner is admitted. If they are admitted, JLP is no longer required or it has to be surrendered. Now when you surrender the JLP, what will happen is this JLP you will give it back to the insurance company and the insurance company will pay you 4,000. In that case, the entry will be bank 4,000 to JLP asset 4,000. See, first whatever is the asset, you will exhaust or you will use that amount for that asset. Any extra amount received, you will take it to partners account or you will take it to revaluation account. Okay. Whereas if there is no asset, entire amount, whatever you have received, bank 4,000, you will credit that to revaluation account 4,000 or you can directly credit that to respective partner's account. So in JLP, please keep in mind, if it is an asset, then you will show the asset at surrender value at each year end. If you are not showing it as an asset, entire premium is charged off or it is taken to P&L. Okay, so that was with JLP. Saket, do you have any other question with respect to JLP, or otherwise I will take up an RTP question for our discussion. Separate life policy. Okay. Separate life policy is when A, B, C. We don't have C. Okay. A. Separately, we have taken insurance on insurance cover for each individual. Okay. Now here, let us say 1 lakh cover for him, 1 lakh cover. 1 lakh cover for him and 1 lakh cover for him or her, whatever it is. Now here what happens, if A dies, you will get 1 lakh. But for B's policy, you will get only the surrender value. If B dies, you will get 1 lakh plus the surrender value. So whatever amount you receive from the insurance company, that amount you will credit it to the partner's account. Okay. Now, some of you have, Saket has asked, when it comes to adjustment, what should we do? Now, what kind of adjustment will be there? There will be a balance sheet. In the balance sheet, you will have JLP as an asset. Let us say 6,000. Okay, JLP as an asset 6,000. Firm is reconstituted. The firm is reconstituted. When the firm is reconstituted, what will you do? You will surrender this life policy or you will surrender this asset. Now, let us say surrender value is 5,000. Surrender value is 5,000. So what you will do is, you can take it to revaluation account or you can directly take it to partner's account. In the revaluation account, you will have 2 JLP asset 6,000. By bank 5,000. Automatically 1,000 of loss will be captured. Sir, I don't want to take it to revaluation. You can take it to JLP asset account. To balance, brought down 6,000. By bank 5,000, and by partners capital, in the profit sharing ratio, the gain or loss will be adjusted. Okay. If you want more adjustments, so I have done a specific revision on joint life policy. Okay, you can access it from the free resources, free courses section on our website, or you can, what I'll do is I'll just share it. Just a moment, I'll just share that with you here itself. So specifically in detail, I had done the conceptual revision. You can go back and check this. I'm just sending the link here. All adjustments covered for joint life policy. Okay. Whenever after the session, you can go through it. Right now, what we'll do is we'll take up a new question. Just give me a moment. I'll load an RTP question. And if you want to practice, all previous years RTPs, everything is not available in institute's website. You can, download it from our website, and that would be, helpful for you. So let me just open this. So here you have only 3 attempts. If you want more attempts, you can go to our website and you can download. So related to partnership, let us quickly discuss. Pretty comprehensive question. So this is related to admission of a partner. Okay. So let us see the question. Shyam, Sundar and Girdhar are partners in a firm sharing profit and losses in the ratio 3:2:1. Balance sheet as on 31st March is given below. Trade payables, outstanding liabilities, general reserve. Now whenever you see general reserve, this has to go to these three partners. Okay. Then you have capital accounts. Okay. Land and buildings, furniture, closing stock, trade receivables, cash in hand, cash at bank. The partners have agreed to take Hari as a partner with effect from 1st of April. Hari will bring 20,000 towards capital. So 20,000 will bring towards capital. Value of stock to be increased to 35,000. Now, a lot of students sometimes miss this, whether it is to or whether it is by. Here it is to, here it is by. Okay, so please be careful. To 35,000 means what? Stock is currently at 31,500. You have to show it as 35,000. So increase of 3,500. Furniture and fixtures depreciated by 10%. 18,000 you will depreciate it by 10%. Okay. Provision for bad and doubtful debts should be provided at 2%. Value of land and buildings to be increased by 14,000 and value of the goodwill be fixed at 45,000. Now they have just said value of goodwill be fixed at 45,000. They